Joining us, John Petrides is a portfolio manager at Tocqueville Asset Management. John, we got a day in which we've heard from Jerome Powell in an interview, but we've got crazy stuff we got to process in the political arena from over the weekend. Then the inflation print from last week. I mean, summer months maybe, but this is like one of the wildest 3 days for markets I can recall. What do you think?
Yeah, I think what you're seeing is whatever the catalyst may or may not be in terms of the narrative, you're definitely seeing a rotation out of growth and into value on the margin. I mean, look, over the last decade, growth has destroyed value from a style standpoint. So I think the market is realizing that there's value to be had outside of mega cap U.S. tech. And that's where I think you're starting to see money over the last 3 days. And again, whatever you want to deem that catalyst to be, that's what's happening.
Okay. What's most important? Is it just the fact that stocks keep finding new ways to rally? Is that all we, kind of need to know? VIX remains muted. Should we be cluing into the bond market's kind of shift to uninversion in some parts of the curve? Or what's most interesting to you, John?
Yeah, I think that the movement in the uninversion of the yield curve or flattening, I think spreads are, under 30 basis points between a 2-year U.S. Treasury and a 10-year U.S. Treasury. And that's the lowest it's been in some time. We have been in the longest inversion of the yield curve maybe in the past 50 years. So in my opinion, post the CPI number last week is that tightening of the curve where you're getting a bit more of a flattening curve has been the major catalyst, is why you saw small caps rally so much. It's because there's going to be, I think, more confidence from Fed watchers that the Fed is going to cut interest rates sooner rather than later.
Okay. And if we do start shaving off 25 bips a meeting, then does that provide meaningful relief to be, sounds like you're in for the equal weight, the kind of comeback trade. Am I wrong?
Yeah, we've spoken about this in the past in that there is value to be had in financial markets outside of AI related plays. And I think that's what investors are finally starting to come around to. Small caps have been big underperformers. You're seeing in the equal weighted versus the market cap weighted on the S&P 500. International has been a big underperformer versus domestic. There are places where if you're willing to look out 2 to 3 years, that just look more compelling from a valuation standpoint, rather than ramming the AI story down and hoping that the companies that are growing 20, 30, 35% on the top line can continue to do that. Because, look, as we all know, the law of large numbers will kick in at some point in time. Inventories will build at some point in time on the AI side, and you will have a nasty downturn on the AI story. I don't know when it's going to happen. I don't know who it's going to happen to, but I've been doing this for a long time, and at the end of the day, a cycle is a cycle is a cycle.
Now, we were talking about how some of these cloud companies have really struggled in the last couple months during this big AI boom for the mega caps. There's this big rift between hardware and software. If any of the AI trade does slow down, do you think the market wholly overall, John, can withstand that? Does all this other stuff add up enough to offset the way it's been doing today and kind of Friday, but Thursday was the case of the other side where tech does get beat up? Doesn't really matter how much rotation there is.
Yeah, I think there's a couple of ways that you have to slice and dice the question.
Yeah.
The first one is I think focusing on the equal weighted market cap S&P 500 versus the market cap weighted. When you're saying the market, the S&P 500 market cap weighted, the SPY, in my opinion, really isn't the market.
Okay,
we know this. It's a handful of stocks, right? So you want to look at what the average stock is doing on a broader breadth, focus on the equal weight. The second part is there are those companies that are currently making money off of AI because they're selling the picks and shovels. And then there are going to be companies who are going to make money from the implementation of the AI from the picks and shovels that they're buying. Right. So, the software companies are investing in AI to benefit because they're going to hopefully either drive user engagement and or they're going to save costs because, as you guys were talking about in the segment prior, companies are going to have layoffs. They're going to be able to do more with less through the use of AI, so they won't need to hire as much, which they'll be able to save on the cost side. So, the AI story is those companies making money because they're selling chips and functions through those companies buying the stuff to build out their AI platform, who will eventually make money off of their AI platform. And then you hope, or the AI story should continue, that other companies will be able to buy into the ecosystem to leverage their AI platform to make their businesses more efficient. So there are multiple layers to the AI cake. And we all just seem to throw it all together and just say, oh, well, AI everything. There are different elements to those making AI money on AI today versus tomorrow.
I like that. That's kind of like the productivity destination that we're trying to get to eventually, right? That should be also, in theory, to some extent, maybe disinflationary as well. So that's kind of the future for it. John, I want to talk about a trade that you like, a fund in particular, VYMI, kind of going for a more measured dividend style approach. Been lagging on the year, but if any of this hyper Mag 7 stuff slows down, it kind of seems like these are the trades that maybe will be more steady.
Yeah. So the concept behind the idea is not just dividend yield and picking up income as a portion of your total return. It's the fact that there's value to be had in well-established companies outside of the United States. Right? Domestic has far outperformed international, and there's a theme out there that I think is relevant of international companies based outside the U.S. but that sell globally. Right? So if you're an oil company and you're based in France or Italy or Britain or somewhere else in England, but you're selling oil around the world, should you trade at such a discount to the U.S. companies simply because you're domiciled elsewhere? You're selling the same product at the same market price that everyone else is. It's that concept, but apply it to consumer packaged goods, technology, banks, all the other ones. And I think this is a way for my team specifically at Tocqueville, when we have an international allocation to clients, this is a play within that to capture that theme.
Okay. If we start slashing rates, does that, because they've been kind of cutting around the world more than we have, if we go into a full cutting cycle, then does that kind of boost the U.S. element to an extent, though? Like if we start cutting, then it's part of the international story edge comes off.
I throw my hands up, Oliver, because I don't know what to make of the dollar. The U.S. dollar has been stubbornly strong for like 7 years now.
Yep.
So, I could, international is traded at a discount to U.S. for a long time. It is one of the largest discounts that we're seeing on record right now, at least over the last 20 years. I think it's attractive from a valuation standpoint. I have a long-term hat on, so I'm willing to go out deeper and feel like my downside potential is less, or my upside potential is greater than my downside risk on international versus U.S. But again, I don't have a catalyst to say right now is the time, because I don't know what's going to weaken the dollar versus other currencies, and you need that to happen for this to work. All right. So again, I don't know, but I can't time any of it. Can't call when the time is going to happen. Can't tell you exactly the catalyst, but I can spot value, and I see it. And international seems significantly cheaper than domestic to me right now.
All right, love it. Thanks, John. Good to catch up.
Thanks for having me on.
Appreciate the conversation. John Petrides, portfolio manager at Tocqueville Asset Management.